So you can see that, right, Federal Reserve in the year 2021, Jerome Powell says that they will not allow substantial overshoot of inflation target in the letter to US Senator. But this apparently was done on the April 2021. But as you can see now in April 2022, Federal Reserve say, we promise you transitory inflation this year, we promise you soft landing, and for the previous heat checks, how we promise you that subprime was contained. Now, this is a joke, by the way, yeah? So what I'm trying to say is this, all right, we hear this last year that Federal Reserve tell us it's transitory, the inflation, but it never came true. In fact, it was sustained. Then they said that, right, there'll be soft landing, but we do see that there could be a potential hard landing. And of course, to rub it in as well, right, subprime problem is still there, although it's contained, but it's not really done. So the thing is this, we can see that the Federal Daily came in and said that, right, must make sure that we don't tip the economy into recession by raising rates too aggressively. So one part is how Jerome Powell is actually saying that, right, they would be more aggressive than not, but his colleagues itself are not seeing the same point. So that's why the joke here is that who to believe and how to believe a federal who actually tells us there's no inflation, or it won't be substantial, it won't be prolonged, but yet it actually all happened. So the thing is this, should we even trust the Federal Reserve to begin with? So this is the question, and this is why everybody is debating. And of course, this become the joke of the day, all right? So the thing is this is where Steve Henrich, right, came in. If the Federal Reserve was really serious about fighting inflation, they would have tightened. But the question is, didn't. Yeah, apparently from the Fed, you can see that the total asset, right, from the Federal Reserve has still climbing up non-stop. The Federal Reserve, the what they call the current base is still climbing up. You can see that it's still climbing up. Because the thing is this, the whole QT, quantitative tightening, will only will only start in May, not now. So that's why the monthly movement is still ongoing. So the real movement itself will be from May. This is very important, guys. May, yeah? From May, that is where the movement will really start. Now, today is the 22nd of April. We're about 1 week away from May. So be very careful because the FOMC meeting, I think, is on the 4th and 5th of May. So which means that, right, by that time itself, right, everything will really come to an halt, okay? And this is where it gets very serious. So traders, that's the reason why I understand some people are calling for long in the market. They tell you that technology is a buy. They tell you that stock is good to buy and stuff like that. To me itself, everybody got their own view, okay? Nothing, no right, no wrong. But the thing is this, I am very confident to tell you that the last 10 years, if I were to learn something from the last 10 years market, is to never fight the Federal Reserve. Okay? Never fight, okay? Never, okay? Never, yeah? Never fight, okay, the Fed. All right. The last 10 years, if you have been steadily following the Federal Reserve and you just keep on staying long, you will make tons of money. All right. This is something that I really learned for the last 10 years. Okay. Call me slow, call me lousy, I'm fine. But I think at least I learned something. So next time it's all right, when the Federal Reserve is coming into the picture again, I will know what to do. So the thing is this, I'm only 43 this year, all right? And I just got so fortunate to see Federal Reserve involved in the market since when? Take a look. The Federal Reserve have been involved in the market since 2009. And from 2009 until to date, let's do the mathematics, right? 22 minus 2009. The market has been involved for the last 13 years. Come on, man. Which last time where Federal Reserve is involved for 13 years? The answer is no. So for me, it's all right. Of course, for what we learn in the market, we also like to learn, okay. So let's just look back into this tape once again. So you remember in 2009, where the Lehman crisis happened, the stock market at 6,600 back then, the Dow Jones. By the time it reached to 2014, the Dow Jones was easily 15,000, okay? Now, take note of here itself, in 2018, that was where there was some tapering, there was some QT, okay? The stock market dived almost 30% from this peak to the lower point. Now look at the magnitude of the QT at that point, and the stock market reacted by going down by 30%. So now we are going to see the same thing happening in the next few months. So my point is this: I don't expect the market to really take off like $1 trillion without holding back. My point is this: if you look at it from a very technical point of view, okay, let's say we put this line into here, okay, and here, so that we have no parallax error. So you can see that, right, it probably have taken about $900 billion from the system. And the market reacted with a 30% drop. So my question is this: with the market now at the new all-time high level, we don't need to say about 30% drop. We talk about, let's say they really go for this 900 billion, because they're looking at least 2 trillion knockoff, but we talk about halfway, let's say 900 billion. So you're going to be dropping like 900 billion to be somewhere near here, okay? So what do you think will be the drop of the market? Now do note, this is from the all-time high level. All-time high level for the Dow Jones, it dropped by 30%. Okay, just to show it to you, right? Not to make it up or nowhere. Let me just get you the charts. Just stay with me. Now today's MAO is definitely going to be very impactful. You don't want to miss this, okay? You really don't want to miss this, okay? Now quickly tell our friends now to join us, because I haven't really started yet, okay? So there will be lots of things to talk about, okay? Let's just take a look here as well. Okay, let me just compress the chart a little bit for our understanding. Oh, yeah. Okay, so I want you to do a comparison that will be easier to understand. Okay, so this is the chart right now of the Dow Jones. Okay, now take a look, everybody. Just take a look. Now this is the period. Okay, the period whereby the Dow Jones, you can see, right, the Dow Jones itself from 201. Okay, a little bit more sideways so that you compare the notes. Okay, can we see that right now? Okay, a little bit more. Okay, here we go. Okay, so everybody take a look and compare it yourself. Okay, compare it yourself. Now you can see that very clearly the Dow Jones itself, right, started coming in, the Federal Reserve, the money, right? Yeah, the money came in back here around 2009. So that was where the Dow Jones actually bottomed out in 2009. Can you see that? Beautiful, right? Okay. So once the money came in, the US Federal Reserve pumped all the way until 2018. Can you see that? Okay. Now look at how the Dow Jones reacted all the way to 2018, all the way. Can you see that? Beautiful. Can you see that? This is how it goes. And I'm so sorry, earlier I get it wrong. It's 24,000, 25,000. So the Dow Jones was at 6,600 over here. And by the time we reached here itself, was already 25,000. Wow, what a jump, okay? Okay, so now what actually happened is that, okay, you can see right now when about near to the, when the market was, the QT was actually happening, you can see how the Dow Jones reacted. Look at the way it reacted. The Dow Jones itself reacted more than 10,000 points, a reaction of more than 10,000 points. You can see that, right? You take the high here to the lowest point, is easily 10,000 points. All right, not to be specific, that's where 10,000. Now, if the market high is 30,000 and 10,000 points move down, we're talking about 30%, easily 33%. Okay, so the question is this. Now we are here, right, at the X point. All right, so if let's say now we do have a similar $900 billion QT, if they really follow through, okay, by letting it expire, then of course the market to drop by at least 15%, I think from the all-time high, I think is actually possible, right? What do you think? Right, if you think that the market can drop by 15% from the all-time high, and it makes sense, key the word possible. Key the word possible if you think so, okay? All right, let me know. If you think it's possible, let me know. All right. All right, so I can see that Anthony writing possible, Danny is writing it possible, Stephen also write it possible. Okay, so the thing is this, we are being factual here. I know I don't want to quote a number of it from thin air. I don't like to say things and I'm not responsible for it. To me, it's all right. I like to share things that make some logical sense, and there must be something to actually, have a reference point. So what you look at here right now, right, makes a lot of sense. So you can actually take a picture right now and really a picture and say that, hey, does it make sense to you? It makes lots of sense to me as a trader. So if let's say if we are putting it as 15% as possible, now everybody please put on your handphone on the camera mode now and take down this number, because this is going to be really crazy. All right, clear out the screen. Okay, I'm going to bring in the charts in right now. Okay, here we go. Okay, everybody take a look. Now this is the Dow Jones, as you can see right now. This is the Dow Jones at the all-time high recently at 36,953. Okay, all right. So the thing is this: if the Dow Jones is to really reflect what is happening, as we just said about this down by 15%. So you take the number the high, you multiply by 85. Okay, you will get the 15%. So what number is that? Everybody take a look. That is 31,410. Now, where are we now? We are now at 34,706 and 7. Okay, and 7. Okay, everybody take a look. So if you look at it right now, mathematically, all right, we are now, let me just do the maths then, quick one, yeah? I just put number 34,707 minus 31,410. Wow, this is basically a difference, okay, a difference of 3,297. Oh my goodness. Now imagine that if you were to short a contract for the Dow Jones, okay, and put a reasonable stop loss, okay, reasonable. All right, let's say we do a stop loss of 200 points. Let's say we put a stop loss for 200 points. Let's say 34,900, okay, as a stop loss, okay? 200. So we put a stop loss for 200 points. Okay, all right. Now, if the market really goes and hit our stop loss, we lose 200 points. But if we take 3297, okay, 3297 divided by 200, I will get approximately, okay, 200. All right, I will get approximately 16. Now, what is 16 then? What I'm trying to say is, if I were to take a short position right now with a stop loss of 200 points, okay, I am risking 1 to 16 chance, which means that if I get it correct, I will win 16 folds of my stop loss that I allow myself to risk. Can you understand that? So which means that, right, I'm taking $200 now, okay, to risk to win potential $1,600. Can you understand that? Okay? Oh no, $3,200, sorry, my bad. You take $200, if let's say every 1 point is $1, you take $200 to risk to win $3,200 16 times, okay? So of course, if your stop loss is going to be even smaller, let's say 100 points, then you're going to make even more money with that concept, all right? So now the question is this, okay? Is it even feasible or possible? Well, I don't know whether the market will come down like that, like immediately like this, but again, it's anybody's take. But what if it happens? Then of course you have one good trade right now, okay? So guys, do you understand what I have just drawn? If you understand, key the word understood. All right. So if you understand what I just say, key understood. All right. Now, whether or not would you be utilizing it or will you be using it to trade accordingly, that I leave it to you to decide. Okay. But this is how I'm looking at it right now. All right. Now, of course, the market will not come down in a straight line. I don't think so. It may take about 3 months, it may take 4 months. I don't know. But the thing is this, as a trader, what I'm seeing this, something that I need to share it with you, quite important. Yeah, let me just share this with you as a trader. Now, the last time we saw the market coming down, okay, let's just draw for you. It came down all the way. It came down to this point, right? Okay, and then the market rebounded. But this time around, after it rebounded, it came down all the way and had a lower low. And of course, did the market rebound? Yes, indeed, it did, in fact. Okay, so what we are seeing right now is that actually it's a lower high formation in terms of the cyclical high. So by right, if you can see this, okay, over here, when the market came down back then, it came out to the halfway point. So if the next trip, if the market really goes down, if the next time the market really comes down, there is a very good chance the market should be able to come down to here. Can you see that? All right, so that's the reason why I felt that it is actually possible. Now, the thing is this, let's see in terms of time frame. Now, the last time when this happened, from the highest point to the lowest point, it took only 13 trading days. Yes, 13 trading days. It took only 13 trading days for the market to drop from the highest point to the 90% mark. Okay, 13, yeah? Now, if you look at it again, from the highest point to the lowest point, it took only 12 days. 12 days. Okay, 12. Incredible, 12. Yes, no kidding. 12 days for the market to come down. So what do you think? What do you think? All right. So the thing is this. All right. If let's say we are talking about this is the first day, 13 days is all right. Let's say do the 13 days with somewhere around here. Okay, somewhere around here, 13 days. So how many 13 days is this? Okay, so we're talking about the first day itself is yesterday, right? If I say yesterday was the day, then of course, plus yesterday, we take 13 days. Okay, we give it, make it 14 days. How about that? Make it nicer, lah. Let's say the market really dropped, and you take about 14 days. 14. Let's say we do the worst of the worst. Worst. Okay. So which day would that be? Which day would that be for the market to reach this point? What do you think? Can you give me a date now, everybody? Can you look at your calendar right now? If yesterday, which is the 21st of, yesterday was 21st of April, all right, 21st of April, if we plus another 14 trading days, what day would that be? Can someone key the date for us? Wow, the answer is out. The answer is the answer is 12th of May. Wow, really, yeah? 12th of May. Okay, all right. Now, what do you think? Do you think it's possible? Do you think it's crazy? Okay, I don't know whether would this really happen. I really don't know. I did not prepare this segment this morning. I did not. Trust me, I did not prepare this segment this morning. All right, it's just that suddenly something just come to my head, and I'm just basically sharing with all of you right now. So take a camera now, take a picture of this, which I just done for myself. All right, and think about this. Would this actually happen? Okay, now 12th of May. What is in between from now to then? Well, basically, we have all the FANG shares coming out, the earnings. We have the FOMC meeting minutes. So FOMC meeting, all right? So these are all the big things that will be coming in between, all right? I'm not too sure, is there any more thing going to happen in between? But the thing is this, I know one thing for sure, that Putin has to complete something by 9th of May. Interesting, right? So all these things itself tells me from now till 12th of May itself, right? I just need to be a bit more careful. And with some stroke of luck, we may be able to see something very rewarding. Of course, stop loss is always needed. Now, do note, stop loss, I repeat, is always needed. Yeah, you must have stop loss for every single trade. So the only thing is this: how much you want to risk versus how much you want to gain, right? It's accordance. All right. So if you basically bet $1, example, if the pot give you 16 times return, then you get $16. If you put $1,000, then of course you will get 16 times return, it will be $16,000. Okay. All right. Now, if you like this sharing, if you like what I just shared with you now, put the word like, please. If you really like this, do me a favor, key the word like. And then after that as well, right, you can also do me a favor, use the emoticons and put all the very lovely emoticons for me, all right? That will be the best way to thank me, all right? Just put the emoticons, the like, the love, the care, the laughter if you want to, or even the wow. Okay, now of course, if you still want to give me the angry face, then I'm fine. Okay, I'm not saying the market had to crash. Basically, it's not a crash. Now, down by 15% itself is never a crash. Down 5% is just a normal pullback. Down 10% is considered correction. Down 15% is a note to be worried, but it's still 5% away from a bad territory. So down 15% in a market like this today is really, really okay. So that's the reason why I felt that, right, 15% itself from where we are from the highest point is still very reasonable. Okay, it's still very reasonable. Like it, right? Very interesting, right? Cool. Thank you very much, guys. Thank you. All right, so take note of this. I'm gonna move on here. Okay, clear. Okay, so with this itself, well, I know that everybody has a different view, so please do not put me and other people and compare. I'm just sharing with you what makes sense over here. Okay, end of the day, you have to make your final decision. Okay. Now you can see that, right? Whenever the commodity index totally goes way crazy, it's always a war. Almost, we have World War I back in the 1914. That was where the commodity prices hit 40%. Okay. Then after that, the New Deal. I can't remember what is that all about. But World War II in 1942, Korean War, where the two-side Korean fight, the Yom Kippur War, the oil shock. All right. I think this is the, is it the Vietnam War? Okay, I don't know what this means. All right, the oil shock too. And then we have now, really, we're talking about high level here. Those small we don't consider, we're talking about high level percentage gain. So it seems to be, right, when we have war, okay, we will have crazy numbers. But now we are not even at war yet, are we? So we are not even at war yet. So we cannot be having this, correct? Or is this coming in? That is whereby it gets very interesting. So now the thing is the PPI is soaring. The commodity prices are literally off the charts. We know that. We're nowhere near the peak. That is definitely. So the only thing that reverses is a massive market meltdown. Now, I kind of believe in that. And if you actually listen to what Jerome Powell has been saying, it does seem that his intention is about that. So if the Federal Reserve is coming into the picture and they are starting to liquidate some of their position, or they're not going to continue to pump in more money into the system, we may have a problem, guys. We may have a problem. So with that understanding itself, right, yesterday I already tell you that